Investors, hello! This is Stock AI Insights, your chief AI analyst. Just a reminder, this is for educational reference only, and it's not investment advice. Investing always involves risk. Today, we're deep diving into an analysis from Empire Learning by Christian Hill called November 2025 Housing, Rates Ease, Hope Returns. We're going to get you the key market insights in just a few minutes.
So, here's how we're going to break it all down. First, we'll look at the big catalyst driving the change. Then, we'll see how the market is reacting, what's up with supply, what all this means for prices, and finally, we'll look ahead to what's on the horizon.
All right, let's jump right in. The single biggest thing breathing life back into the housing market right now, it's that mortgage rates are finally coming down. This one shift is really the engine behind everything else we're about to talk about. And this slide just puts it in stark relief. I mean, think back to earlier this year. Rates were hanging out above 7%, which was a real struggle for buyers. Now, fast forward to late October, and we're looking at rates around 6.3%. That might not sound like a world of difference, but for a buyer's monthly payment, that is a huge deal. It's what makes a home affordable again. And what this quote from a mortgage pro tells us is that we're seeing some newfound stability. See, after the Fed cut rates back in September and October, the crazy roller coaster ride seems to be over. The thinking now is that we'll see more gentle, day-to-day moves instead of those wild swings that gave everyone whiplash. Now look at this chart. This shows you the immediate domino effect of those falling rates. You can see refinance applications absolutely surged. No surprise there, homeowners jumped at the chance to lower their payments. But what's really key for the market's health is that bar on the right. Purchase applications also got a nice little nudge upwards. That's our first sign that buyers who've been sitting on the sidelines are starting to say, okay, maybe it's time. So, we know lower rates are tempting buyers to come back to the table, but are they actually signing on the dotted line? Let's look at the numbers, because this is where we see the first real concrete signs that the market is starting to thaw.
The headline number here is a 1.5% increase in existing home sales. Now, I know what you're thinking, 1.5% doesn't sound massive, but here's the thing, it's not about the size, it's about the direction. After months and months of decline, the trend is finally pointing up. That's a big deal.
And hey, don't just take my word for it. Lawrence Yun, who's the chief economist over at the National Association of Realtors, put it pretty plainly. He says, falling mortgage rates are directly lifting home sales. It's cause and effect, plain and simple, and that adds a ton of weight to this recovery story.
Let's dig a little deeper into who's doing the buying. This chart is really interesting. First-time buyers now make up 30% of the market. That's up from just 26% a year ago. Why does this matter? Well, it's a fantastic sign of a healthy, broadening market. It means it's not just investors or high-end buyers anymore. The core of the market is getting stronger.
Okay, so that's the demand side of the story. But you know sales are only half the equation, right? Let's flip over and look at supply. We're seeing inventory levels finally start to look, well, normal again.
And this is a major shift. The number of homes for sale is up about 14% from this time last year. For anyone who's tried to buy a house recently, this is music to your ears. It means more choice and a lot less of that crazy, frantic competition we saw a couple of years back. You know, economists have this term, months of supply. It's basically a measure of how long it would take to sell every single house on the market right now. And we're at 4.5 months. Now, a balanced market, where neither buyers nor sellers have a huge advantage, is usually somewhere between 4 and 6 months. So, we're right on the doorstep of a more normal, balanced environment.
But it's really important to understand why inventory is going up. You might think it's because everyone is suddenly listing their house for sale, but that's not it at all. In fact, a lot of homeowners are locked into those crazy low mortgage rates from a few years ago, so they're not moving. The real reason inventory is rising is simply because homes are sitting on the market a little longer. That slower pace gives the supply a chance to build up naturally.
So what we have is this fascinating kind of standoff that's just now starting to break. For the first time in a long time, buyers have options, and they're gaining some real negotiating power. And you can see it in the data. 1 in every 5 sellers is now cutting their asking price. That was practically unheard of just a year or two ago.
This all leads us to the bottom line, the question every investor wants answered. With demand slowly coming back and supply also on the rise, what on earth is happening to home prices?
Well, the median home price is holding pretty steady, right around $415,000. That's a modest 2% increase from last year. The key word here is stability. Prices aren't crashing, not by a long shot. Instead, that explosive growth we saw has finally flattened out to a much more sustainable, normal pace.
And this is the question that's probably on your mind, right? With all the headwinds the market has faced, with slower sales and rising inventory, why didn't prices just fall off a cliff?
Well, the answer is that the market has some really strong fundamentals, almost like shock absorbers. We still have a long-term housing shortage in this country. Plus, most homeowners have a ton of equity and those great low-rate mortgages we talked about. There's just no widespread desperation to sell at a loss. That means things like foreclosures are still incredibly rare, only making up about 2% of all sales.
So, let's pull all these different threads together and look forward. What's the outlook as we head into 2026? All the data seems to be pointing towards a cautiously optimistic future. It looks like a brighter horizon.
And this slide kind of lays out the roadmap for how we get there. It's a pretty logical sequence. First, rates continue to stabilize. That encourages those sideline buyers to gradually come back. Meanwhile, new construction adds more much-needed supply to the market. And underneath it all, you have this huge, consistent wave of demand from millennials, which provides a really solid floor for the entire market. This little table just perfectly sums up the shift in the power dynamic. Think back to 2021 and 2022. Sellers had all the leverage, and buyers were making rush decisions. That world is gone. Now, in late 2025, sellers have to be realistic about pricing, and buyers, for the first time in years, have more breathing room and more power to negotiate.
And this whole new dynamic has led to this popular saying in the industry, date the rate, marry the home. The idea is pretty simple. It tells buyers to focus on finding the right house for them right now, even if the interest rate isn't perfect, because they can always refinance to a better rate later on if conditions keep improving.
So if you take away just one thing from all of this, let it be this. The housing market really does seem to be putting its most challenging period in the rearview mirror. We're entering a new phase, a phase of stabilization, all thanks to those easing rates and inventory getting back to normal.
And that leaves us with one final big question to think about. As the market finds its footing, has the greatest risk for investors shifted? Is it no longer about a potential crash, but about the possibility of missing the recovery altogether? Let me know your thoughts in the comments. I'll see you in the next episode.